So every day we have a new franchise brand appearing on the scene.
That's right.
But now going back to if they're going to depend on their franchisees getting SBA loans, that may not be as easy as it used to be because the lenders are pulling back a little bit on these eligibility issues.
Well, and thankfully that the certification of franchise eligibility for SBA lending that FRANdata created is solving that, right? So we have been actively working with all of the lenders. We have one lender that is a very big franchise lender, and they require the certification. They invited me onto their team meeting with 80 employees to help them talk to franchisors, because some franchisors don't understand that there's still requirements.
Welcome to the Franchise Hot Seat Podcast, where we talk about all things franchising. Now, here's your host, Dr. John P. Hayes.
My guest is Edith Wiseman, and she's the president of FRANdata and knows everything about franchising, at least statistically, and what information is true and what information is not true. Not long ago, Edith, Franchise Times said that you're a rising star in franchising, but I think the star has already been in place for a while. You're definitely a star in the franchise community. Thank you for joining me today. I appreciate it.
Thank you for inviting me. I'm excited to be in the hot seat.
Yeah. So in March, FRANdata said that lenders are looking for deals. And about a month later, things might have slowed down. Lenders are adopting temporary measures because of standard operating procedures regarding franchise eligibility. What's that all about, and how's it shaking out?
Yeah, so SBA changed last year their standard operating procedure, as you said, and they decided that affiliation was no longer something that lenders would need to worry about. So they actually changed the regulation so that any type of loan, affiliation was not a concern. So before, lender would have to worry, was the franchisor affiliated with the franchisee, and they'd have to be vetted to make sure they weren't. So that's good news. No, you don't have to jump through that hurdle. The downside is that during that process of franchise affiliation review, the SBA was also determining whether a franchise was eligible for an SBA loan. So in the statute that the government has provided to SBA, they are required to make sure that business is actually eligible for a small business loan. So, for instance, would be a business that's passive. They want someone to be running an operating business, not to be just collecting, say royalties or say just rent. So some business models in franchising are set up as passive businesses. And if they are, then they would not be eligible. Well, this is something that a lender has to vet for, whereas before SBA was vetting for.
Okay.
So since then, go ahead.
How does a bank determine that there's affiliation and that becomes an issue? How do you show that?
Well, so some lenders actually still think that affiliation reviewing, even though SBA said affiliation no longer matters, there are some banks who are saying, well, actually it's a credit issue. If a franchisor is too controlling, that could be a credit concern. So there are some banks today who are saying, you know what, all those rules that SBA says no longer applies. Well, we actually agree with that, but it's not from an eligibility standpoint. It's from a credit perspective.
Wow. So
I came up with this term that's that was presented in front of lenders at the Mid-America Lenders Conference in Texas, and it's called costly and chaotic. So right now, how lenders are handling this is very different, and it can be very costly to a franchisee, a franchisor, and the lender. So FRANdata has developed a certification of franchise eligibility for SBA lending. And we actually developed this last year and had close to 250 franchisors sign it. And it was in their account on the franchise registry. So a lender could just go in, grab it. And then basically the franchisor is certifying, self-certifying that they abide by all of the eligibility rules. And they're all listed in this document. And we are coming out with a revised version in May based on updates from some franchisors who said they couldn't sign it. Some lenders have provided feedback. So we're basically making the next version so that it's a better version. But in the meantime, what's happened is one of the largest SBA lenders decided to not lend to any new franchise because they just didn't get their arms around what to do and how to handle this. So they were actually just kind of hoping and praying that like things would go back to the way it was before. And now here we are, and franchisors are coming out with their new FDDs, and lenders are like, uh-oh, what if the franchisor changed something and I can't like rely on what SBA said? So we have a number of franchise lenders that we're working with who are looking to require the document that we have created, the certification for lending to franchises on a go-forward basis.
So this is potentially a big deal, particularly for an emerging franchise. If the lenders, and it's only one lender, I think you said at this point, but if lenders decide we're not going to loan to new franchise brands, what percentage of franchises are considered emerging, let's say under 50 outlets?
A lot. I mean, I would venture to say under 50 outlets would probably be about 1,000 franchisors.
Out of how many? Which is another number I wanted to clarify with you. I hear people say anywhere from 3,500 to 5,000 brands in North America. So what's the real number?
It's a hard number to quantify, and the reason why is because how we determine it is we call it active franchise systems, which means that a franchisor is actively trying to grow their franchise system. But there are, small franchise systems that are not actively trying to grow who fall off our radar, who might have like 2 or 3 franchisees and they're just kind of operating. So that would be something that if they haven't actively pursued franchising in the last 3 years, they'd fall off our radar. So what we count as active, that's what our count consists of. So it's approximately, it ranges between 3,750 to like 4,000 a year, give or take. There's ebbs and flows, but that's generally the range.
Okay, so there could be as many as 4,000 active franchise brands. Is that correct?
That's right. That's right.
All right, good. Now, it's also, and I know I got off track where we were talking about eligibility. We'll come back to that. But this number of franchises is boggling because I think I saw a statement IFA said that there's a new franchise brand introduced every day, or maybe FRANdata said that. Truth to that? What's that about?
It's true.
So every day we have a new franchise brand appearing on the scene.
That's right.
But then now going back to if they're going to depend on their franchisees getting SBA loans, that may not be as easy as it used to be because the lenders are pulling back a little bit on these eligibility issues.
Well, and thankfully that the certification of franchise eligibility for SBA lending that FRANdata created is solving that. Right. So we have been actively working with all of the lenders. We have one lender that is a very big franchise lender, and they require the certification. They invited me onto their team meeting with 80 employees to help them talk to franchisors, because some franchisors don't understand that there's still requirements. We had one franchisor say that, SBA is not even lending to franchises anymore, right? So there's confusion. And we had one franchisor say, like, I'm not going to sign it. And the lender said, well, you're not going to sign it. We can't do the deal. And guess what? They signed it. So, there is a middle ground, because the alternative is some smaller lenders are using outside counsel to do reviews for every single document, for every single loan review, and that's costly to the borrower. It can range between $1,500 to $4,000. And then if you multiply that, now the franchisor council has to respond to what the lawyers from the bank want. And now we've got more time and energy and cost and delays. So that's why the certification is such a beautiful solution, because it takes out all of that friction.
So it's true, SBA continues to loan to franchising.
Absolutely.
But at what rate compared to the way SBA was lending, let's say 5 years ago? That might not be a good example because the pandemic was
right. It's still very strong. So because I think the thing to just keep in mind is that larger franchise systems grow faster in terms of net new units. So while emerging brands and new brands would be most affected by this change, in terms of like the greatest demand for SBA loans is going to come from you're slightly past that emerging stage. So maybe at the 40 mark is where you're starting to gain some momentum, and that's where you're going to see the most demand.
So advice to these emerging companies that may run into some resistance from lenders, what do they do? How can they solve this problem, and can they do that through FRANdata?
Yeah, it's very easy. Just give us a call and we will talk you through it. You have to become a member of the franchise registry, which for an emerging brand, I think it's $750. And then we put all of your information up on the franchise registry, send you the certification, go through any questions that you may have, and also understand like what types of financing needs that the system has. So for instance, some emerging brands might only need, their franchisees might only need, I don't know, $150,000 worth of capital. Well, the type of lender that you're going to go to for that is going to be very different than the lender who's doing $500,000 loans. So we'll help give the landscape, help them understand the landscape of SBA lenders and where they're best suited to find the financing partner that is best suited for their franchise system. To be clear, we're not a broker. We love finance brokers like Penetrends and like Business Finance Depot, who are there helping the individual borrower find a bank. This is more just understanding where they're best suited and who's going to really help them.
So in improving this eligibility, I'm still a bit confused about that. Let's say you're a franchisor and I'm a franchisee.
Yes.
Do we have to establish that there's no affiliation between us, and whatever? Give me an example of what affiliation would be and why that might be a credit issue.
So now in our certification, we did not take that stance that affiliation is a credit issue. But there are some, we've heard from a few lenders who think it is. So, but I'll give you what they might say. So one of the previous rules that SBA had created around affiliation is that the franchisor couldn't control the money flow of the franchisee, right? So imagine that you're in a service-based system and the money first goes to the franchisor and then the royalties share split goes to the franchisee after the fact. They would say that the franchisee isn't in control of the money. And if that's the case, that's a credit concern, because their reliance on the franchisor to pay the franchisee, not the customer. And the customer is the franchisee's customer. So in that perspective, the franchisor could stop paying the franchisee, and then who's going to stop paying the loan? So that's how they might view that as a credit concern.
But that's very few, right? It's commercial cleaning franchises primarily, where the franchisor collects the money, pays the franchisees, or are there a lot of others that I'm just not aware of?
I mean, it can exist in other franchise systems. So if you think like national accounts programs where maybe payment is set through the franchisor. There
Yeah,
are
that's true.
ways that the lender can get control of that money. So, like in the personnel services industry, the franchisor has to sign an addendum that says that the franchisee, the lender, can take a security interest in the accounts receivables. So there are ways around that issue, but it is a credit concern.
Okay. And are there other eligibility criteria you can give us as examples, maybe the easier ones, and then maybe what's the big challenge? If there is a big challenge, is there a tripping point for franchisors in the process?
Yeah, I'll give you two examples that a lender I just talked to last week. She said, "Oh gosh, we've financed this a business that basically is a bin that they stick in a parking lot of maybe a school or a business,
Yeah.
and people drop off their clothes that they no longer
Yeah.
need."
Great business. Yeah.
Well, so the lender is having heart palpitations because she said, "We've lent to a whole bunch of these, and I don't know if they're passive.
Hmm.
Like, how are they actually actively operating the business?" And so that's one example, passive. The second is there's a very fast growing, like, men's health franchise. And she also said to me, my heart is palpitating because I don't know if they're eligible, like, because they might not actually service women, they're only servicing men. And this is a very fast growing franchise, so lots of lenders are doing these deals. So unless there's some sort of verification to the lender that, like, these things are actually eligible. So in the case of the fast men's health business, they actually have to sign an affidavit that says we do not discriminate against women, right? So women can come and use our services if they want. And then further would be better to actually show that a woman has used their services, to show that that is truly eligible. In the case of the bin, placing a bin somewhere,
Yeah.
it's a little bit, I have to say, like, I read it and I thought, it's eligible. It is.
Yeah, because I know one of those franchises, and I've spoken at their convention the last 2 years, and those franchisees are very involved. They just don't have to stand out there and collect the clothing, but they have to go get the clothing, and they've got to prepare the clothing so that it can be sold to markets so that they can make money. So they are involved, but I can see how that could be a question. The issue on a business that serves only men. Come on, we had Curves. Were there any men working out at Curves?
Which was an
Nobody
issue.
complained about that.
I'm so glad you brought that up, John.
All right.
That was an issue.
Hey, old white guys, we need all the help we can get.
So Curves was an issue, and Curves franchisees had to prove that they had 2 changing rooms, one for men and one for women.
Okay.
So it actually increased the build-out cost because
Crazy.
they were discriminating because it was female. So the way I describe it is, a franchise system can be eligible if it's focused on one gender, but not to the exclusion of another.
Okay.
Right. So, like, it's a fine line, but
Yes. And I don't know how Curves was or wasn't. I never worked out at Curves, and I didn't want to. I knew it was, hey, that's where the ladies go. Great. Well, I guess men are not allowed to have their own thing. That's crossing the line. That's a whole nother story, not related to what we're talking about necessarily. But franchising has so many complications that people don't always consider when they come up with an idea. Which also now, on this passive issue, what about all these absentee and partial absentee? And hey, don't worry about, keep your job. Don't worry about running your franchise. We'll do it for you. You just pay us a little more. Are those going to fall into the passive category, and lenders are going to have a problem with that?
So it is a concern, but I think there's some in our certification. We outline the things that SBA historically has said how they're determining whether something is passive or not. So is the franchisee in control of the bank accounts? Are they the ones who are determining like the hiring and firing? So like there's certain functions that the business owner has to perform, or at least not be taken from them, right? So like in the case where there's a management agreement in place, there has to be certain provisions that allows the franchisee to be in charge of these things to be an active business eligible for SBA financing.
So, what if there wasn't any SBA lending? How important is SBA lending to franchising in the United States?
It's very important.
So, at least 20% of new franchisees are using SBA guaranteed funding?
No, in any given year, 20% of the SBA portfolio
Okay.
is to franchise businesses.
Yeah. So that'd be a huge loss if we weren't able to get guaranteed funds through, if banks weren't able to get guaranteed funds that they can loan out to people with the SBA backing it up. And traditionally, the SBA has been a backbone of new businesses, period. So this is an important issue that we're talking about, but some franchises may run into trouble as a result of some of these recent changes. But are lenders still gung-ho about franchising?
The answer is emphatically yes, when it's a quality franchise system.
Okay, that's a big qualifier. What is a quality franchise system?
Well, so FRANdata credit risk rates every single franchise system that has 50 units or more has been franchising for 5 or more years. We also credit risk rate younger brands. So let me give you an example. If we're credit risk rating a younger brand and they've just they have a few franchise units, and it looks like half of their few franchise units that they opened up have failed. Now, if you're a lender and you are going to give your money, would you say, I want to take that bet? Probably not.
No. I'm going to pass for a while.
I want a 50% chance. I want a greater than 50% chance of success. So, and there's always this balancing act, I will say, between a borrower, franchisee borrower, and a brand. So if there is a case like that, so let's take it's all very specific, because some lenders are just say, like, we only are going to lend to franchises that have 100 or more units, or we're only going to lend to franchises who are already in business, or so there's qualifying criteria around what each lender is comfortable with. So if a lender has a footprint, like they have actual branches in an area, they tend to be willing to take a greater risk, because like they feel like they're servicing their community, and so they want to be there for their community. But if they're an SBA lender that has a footprint, like say in Ohio, and they're lending in California, which is not as friendly of a state to lend into, business conditions aren't great, they're going to be more conservative. So there isn't a one size fits all whenever you're talking about lending. But if a lender is open to lending to newer franchise systems, and they would look at that. So let's say it was this instance where they've only had a few franchise units, half of them failed. But they have a borrower who is very, very strong and has maybe experience in that industry. And they might look at this situation and say, okay, can we fully collateralize the loan? Can we project cash flow based on this business plan and this person's experience? And even though this is what we consider like not a great actually not really a franchise system. In that case, they'd probably look at it like it's not a franchise. We're actually putting our eggs all in this guy's basket or this woman's basket, and we're not even factoring in the franchise at all. We're pretending like it's an independent business. That's where that might get financed versus like a
So,
Culver's who's never lost a franchise. Every lender
Yes.
is going to be like, here, take my money.
Right. So, should I be concerned if I'm buying a franchise, the franchisor, I'm going to be the first franchisee, but I need a loan. I need an SBA loan. I'm probably not going to get that. Is that correct? Or are there banks that will lend to, okay, you don't even have a franchisee. You're going to be franchisee number one. We're going to loan $300,000
Yeah.
to you.
The good news is SBA lenders are used to lending to people starting their business for the first time. It's just that the franchise piece of that isn't going to really be considered in the loan evaluation. So if you think about the franchise system could be considered either a plus, a neutral, or a negative. In that case, it's not even considered, right? First franchisee for a new franchise system. It's not a franchise yet. There's no systems, there's no support. This is 100% determined on the individual borrower to make it successful. And there may be some data, but like, let's say for instance, my cousin and her boyfriend are close to buying area development rights for a franchise that's out of North Carolina. They're in Texas. And when I reviewed the franchise agreement, I had to kind of chuckle because they say, like, you must use our real estate brokers to pick sites. And I'm like, you have one location in North Carolina. I'm pretty sure you don't know Austin, Texas. Okay. So, and also, they're changing things in the system, right? So like from 1 year to the next, the advertising fees are different. And so you're like, this is a system, they're just figuring things out. Like it's not a business in a box that can be replicable with a high degree of certainty. And so it is the onus is really on my cousin and her boyfriend to make it a success. There's less tools. So any lender who looks at them, they're looking at my cousin's experience, her boyfriend, and their financial background, and what they bring to the table in terms of their executive experience and operating experience.
Okay. So, didn't all of this used to be easier when the SBA published its directory, or am I imagining that?
So, I mean, I think that there was a perception that it was easier, but all the things that you and I just talked about right now are all credit things that they always are looking at. And any lender who was just like rubber stamping, well, their portfolio probably looks like a mess.
So it seems like there was a time when you could go to the SBA directory online. You can't anymore. It's been discontinued now for more than a year, I think. You can tell us about that. And you could find out what percentage of loans to a particular brand of franchisees were successfully paid back, which would give you maybe some indication that this is a good risk, because if all the franchisees are paying their loans back, they must be making some money. Not necessarily true, I realize, but that's a good sign. You can't do that anymore. Is that should we see that as a problem?
So the SBA used to publish what was like a franchise loan loss report. And so that raw data is still available. It's just not packaged. So the SBA, I can't speak for them, but my impression is that they recognize that like the data was never perfect. It was never great. So lenders would make decisions on it that weren't necessarily valid decisions. So for instance, if the loan loss report said there was a 50% failure, but they only made 2 loans to the SBA, like there were only 2 franchisees that got loans from the SBA. But meanwhile, there were a 100-unit franchise system. you're like, okay, I mean, a little thinking would have to be involved here to say like not valid. It's not a valid
Right.
representation of the franchise. Um, and so on vice versa, I've seen where there's only a few loans to a franchise system's franchisees. And in our data, in the credit risk report, it shows a 50% failure rate over an 8-year period. So, like, you have both examples where it's not representative. So, I think the SBA just said, we're just going to treat franchise like every other small business. That being
Hmm.
said, the data is still, we collect the raw data just to see like where lenders are lending and what's the profile of loan amounts. So we still analyze the raw data.
Okay. Wasn't there a point, and maybe it still exists, where a lender could look at that data and say, based on the payback of loans or based on the loss of money, we will not lend to this particular
Yeah.
brand? So SBA doesn't do that anymore, I guess, but maybe FRANdata has that kind of
Yeah,
information.
yeah, that's right. So lenders would use that SBA loan loss data to determine whether they wanted to lend or not. Now they turn to FRANdata's, it's called a fund report, a fund credit report, to make those determinations because it's actually representative of the franchise system, right? So we're accounting for all
Okay.
franchise locations. And at this point, over half of all SBA franchise loans are financed by banks that use FRANdata's credit score. So one of my people last week talked to a very large franchise lender who's not using the credit score, and they saw it and they said, we need this. Because right now, people are doing different things in the bank, and SBA is going to look at that and say, you have to be consistent. And this is a fast, easy way to get the information completely compiled for us. And it's comparative and it shows over time. And so it just makes their lives, like it makes them make better, faster decisions. And who wouldn't want that?
So I know you don't speak for SBA. I'm not asking you to, but in discontinuing the franchise registry, what that seemed to be interpreted by some people as the government's not so interested in franchising anymore. They're pulling back. Any truth to that from your perspective?
So I'll just make one little correction because everybody does this. It's the SBA franchise directory that went away. FRANdata's
Okay.
website is called the franchise registry. Um,
Okay.
well, I say
Good.
that because one of our bank customers, when the directory went away, she called us and
Yeah.
was like, "Oh my gosh, does that mean we're not going to be able to get our reports anymore?" And I was like, "Oh my gosh, you pay us to go to our website to get the information."
Yeah.
So, yeah, so it's the directory that went away, and the way I would
Okay.
say I would frame this is affiliation was an issue across all small business loans. So if you think about, okay, you're a dealer, you have a store, and you are like a appliance dealer, and so you've got a contract
Hmm.
maybe with Maytag and with this manufacturer and that manufacturer. A lender would have to worry about each of those contracts for your appliance store. Right? Like how
Hmm.
complicated. And does it
Yeah.
really is it really doing anything? Is it really like most times these things were determined as not affiliated, and so it just took up a lot of time, and it made the lender's job more complicated. And the SBA said we just want lenders to do more loans, right? Like at the end of the day, what we learned, if we put our minds to it, we can get more capital in the hands of small businesses. Now, lenders, they don't necessarily agree with that because they're like, well, PPP had a lot of fraud and it wasn't actually a loan program, it was a forgiveness program. And so there's a lot of distinctions. But what the overarching objective was, if we simplify things, then we can get more loans, more money, more capital into the hands of small businesses, which is numero uno job of the SBA.
So the SBA making this decision about discontinuing their directory, was that accidentally that was a boon for business for FRANdata? I mean, not that you applauded the discontinuance of the directory, but that maybe not such a bad thing, because franchisors and lenders need FRANdata more so now than before.
Well, I wouldn't say it's a boom, because what we decided not to do is we decided not to make this something new, right? So like all of our 400 franchise registry members get access to the certification. So these are franchisors who have been members of the franchise registry, who put financing first, who understand that they want to make it easy for lenders. Before the directory went away, they were franchise registry members. So we just added this into their membership. And so where it is, it does help FRANdata is for any franchisor who wasn't a franchise registry member, they would have to become a franchise registry member to get the certification. But then they get all the benefits of being a financing first franchisor, right? So, and I don't know, I think that that's actually pretty important when franchising relies on capital of lenders to help grow their franchise system.
Absolutely. So I think I saw that more than a couple of hundred active franchisors out of potentially 4,000, so it's not a huge number, but more than 200 have their eligibility certificate. They make that available to lenders through FRANdata. So is that okay? Not a very big number, but how is it significant? And where should that shouldn't every franchisor be doing that if they want to help their franchisee or prospective franchisee get loans?
Not every franchisor can sign the certification. So that there are franchise systems who will look at that certification and say, I can't sign it. And that's the right thing. And for those franchise systems, I'm telling them, redline it and send me back the red line. And we can post that for lenders, and lenders can look at that and say, or, you know what, that's might be okay. So there are some credit things in there. If a franchisor has lease documents that they require a franchisee to sign, and it doesn't allow the lender to be in the first position, or doesn't allow the franchisor to foreclose, like those items can be a point of contention between a franchisor and a lender. So, but there are also some business models that just are not eligible, and so they won't be able to sign the certification. And that's a good thing.
And the number one reason for not being eligible for this certificate, what would that be?
There's not a number one, because it's only like if it applies to you, right? So, so brands like Choice Hotels and Goddard Schools, like they have been able to sign the certificate. They have franchisees who have real estate, whereas some brands that are in the service business have not been able to sign the certificate because it's not that they have a real estate issue, they have a business model eligibility issue. So it's hard to say what's the number one reason, because I mean, as you pointed out, franchising is so dynamic. There's 230 subsectors and different business models, so it just really depends. If you're a female-focused franchise system, well, then you might have a challenge unless you're willing to abide by the specific directions that follow, that you will allow men, and you will sign an affidavit, and you can show that men have frequented your establishment.
So changing direction a little bit, FRANdata also at one point had said that 2024 might be a big year for franchise M&A. And has that Is that the case for 2024? What do you see in the mergers and acquisitions in the
I
franchise
think it's
sector?
amazing that you asked this question, John, because just the other day I was talking to someone who is in the resale business, right? So that's what they do, and
Yeah.
trying to think about where to focus their efforts of like what franchise system to help in this in helping franchisees sell their business. And I looked at a set of, I don't know, it was like 30 different brands. And I was absolutely shocked by the transfer rates. So upwards of 10% for some franchise systems. And we're talking about quality franchise systems. So in our credit
Hmm.
report, we have a section that scores brands based on the volume of transfers because there's a healthy volume and then there's an unhealthy volume. And an unhealthy volume is
Yeah.
kind of a leading indicator that like things aren't working, so more franchisees are trying to sell their business because they see there are increasing issues in their business that aren't being solved. And
Hmm.
in what I would consider very healthy businesses, to see a 10% transfer rate is quite high. But I think that's an indication of what we saw the previous year, which is interest rates have gone up, the cost of capital is high, people think their business is worth something, but when your cost of capital is high, your business is not worth as much because people have to pay more just for the money to buy your business. So I think
Hmm.
what we're seeing is that buyers and sellers are coming together in the recognition that interest rates are not coming down. And in fact, based on the recent news, looks like they might even go up.
So part of this rise, it is a it's higher. That 10% is a higher number than previous years, correct?
Absolutely.
Of acquisitions.
Yeah, I mean, we're
Yeah.
talking about franchise systems that I'd looked at before who had like 2, 3%, right? So,
Yeah.
like,
Okay. The norm. Yeah. Or what we thought
yeah,
was the norm. Right.
there's definite
So,
uptick in transfers.
so one of the things that's happening now, or I think that it's happening, I always try to make people realize that, first of all, franchising is not for everyone, and it may not be for you. And it may not be for you if you've got to start from ground zero in a virgin territory. You're going to be number one, or you're going to for the first time in your life build a business with before you have any customers. Franchising could be a better opportunity for you if you acquired an existing business. It'll be more costly than the startup, most likely, but you've got business from day one. And you like that because you're not as much of a risk taker. And I hear people, and this is reflective of that 10%, I believe, that they're deciding not to start up, but to acquire. Do you see more of this happening, or you don't know for sure? I mean, it's just a
I mean,
guess.
you definitely see it amongst your largest franchisees in the U.S. The conversations that I
Yeah.
have with very large franchisees is they're looking for businesses to buy that they can either optimize or just continue to run if they are good businesses. So I talked to a gentleman who has very quickly grown from zero franchises in one system to being one of the largest because they
Hmm.
have the capital and the experience and were able to become the largest franchisee in the whole entire franchise system of one of which is a very
Hmm.
large system. So you are
Yeah.
absolutely seeing that, and it makes sense because if you have capital and you have experience, then you know how to gain efficiencies. If you're in the customer service business, you know how to bring that experience, regardless of what experience if you're bringing it in a massage versus a stretching business versus a chiropractic, like how to bring that customer focused experience, regardless of what the service is.
Hmm. Yeah. So some people might think, well, 10%, that's a negative. That's an indicator that people are not happy in this franchise and they want to sell it. But that's not necessarily the case at all. Today, there's an appetite among franchisees to own more than one unit and to own 50 units, 100 units. And I think this number may be indicative
So I
of
think
that.
it depends. Every number only has meaning in the context of other numbers, right? So if you are looking at a franchise system where it's a 10% transfer rate, but the historic unit success over the last 8 years is like a 95%, then you're like, all good. However, if you have that
Yeah.
10% and you also have a 60% historic unit success rate, that's a different story.
Yeah. Yes, exactly. People are maybe bailing out of the business. Well, that's certainly interesting and helpful, because a lot of people are still complaining about there's not enough regulation to assist a franchisee in determining if franchising is a good deal for them or not. And I don't have a position on that. If more regulation makes sense, let's do it. But in this topic of responsible franchising that we talk a lot about today, social media has a lot of mention of it. The responsibility here is also on the franchisee or the prospective franchisee to do the due diligence. Look at these numbers that we've been talking about as part of your due diligence to determine whether or not this is the right deal for you. It may not be, and the numbers are there if you just dig around and ask. Does that make sense to you, that these as part of the due diligence that someone's going to do is required, and it's not just calling a couple of franchisees and saying, "Are you happy?"
I agree. On so many levels, buying a business should be more intense than buying a car, right? So, and just because you've talked to the franchisor a few times and you feel like you've gotten everything, you haven't. And you can't, it's not like the what you have at risk is so much greater. And because once you own that business, you own the operating costs of that business. And so that means that not only the upfront, but now all of the operating costs you're responsible for. And unless you understand how to drive revenue to cover those costs, and plan A, plan B, plan C, like, you have created yourself a cash burn situation that can deplete you very quickly. So I think that if people understand that what does diligencing a franchise system look like? It means hiring an attorney or having someone who is experienced in franchising look through that agreement. If you're a first-time franchisee, you better be negotiating that agreement. I would ask for graduated royalties, or at least I'm not going to pay royalties until I hit certain sales thresholds. Like, I'm going to pay you
Yes.
for the right to run this business into the ground. No, thank you. So I'm going to pay you, and we're going to do this together. I'm helping you build a brand that you currently don't really have, beyond that one market and that one unit, or whatever. It could have 10 units, but the point is that
Sure.
you want to get good counsel to make sure that you're putting yourself in a position for success from the get-go. Secondly, you don't want to just rely on the few franchisees that the franchisor says, like, here, talk to Johnny. Why? I want to talk to Susie and Patty and actually all those
Right.
people who left the system, because in order to plan for your success, you have to know what the downside is. So, okay, what did these people experience on the downside, and how do I make sure that that doesn't happen to me? So it's not just about talking to the best performers, because everyone knows that you're A++, because you are going to do better than anybody else. So you also have to be realistic about your strengths, and you have to build an org chart that says, like, today it's just me and my wife or whatever, but I've got to be able to fill in these positions. And right now I'm A, B, C, and D positions, and you have to know what the future of your organization is going to look like and plan for how you're going to get there.
Great information, Edith. I appreciate it so much. Very enlightening, as always, when speaking with you. I appreciate the time. Titus Center is going to bring you back again, of course, to talk to our advisory board. And I look forward to seeing you again soon. Thank you so
John.
much
and
for
I have
today.
to say, thank you for doing what you are doing, which is, it really blows my mind when I look at, the students whose lives you're affecting, whose lives you're helping them get experience, getting mentorship, getting jobs, becoming franchisees. It's really unique, and I applaud you for all that you're accomplishing there.
Thanks for tuning in to the Franchise Hot Seat Podcast with Dr. John P. Hayes. Tune in next time for more conversation around all things franchising.